Yeah, welcome to day 25 of this program, Strategic Financial Reporting, Virtual Financial Reporting for that matter, with respect to professionals and practitioners in the field of accounting and finance. Today stands Saturday, 1st of May, 2021. Okay, today we'll be wrapping up all of our discussions on financial instruments. And the three sections the four sections we're going to endeavor to touch today will be as follows. First, the concluding session of our discussion on impairment of financial assets. And secondly, we'll move to discussing on embedded derivatives. And we'll finalize that with hedge accounting. Okay, and by virtue of the requirement of IFRS 7, we'll look at the disclosure requirement with respect to financial instruments. And we'll call it the end of that topic or of that course. Now, to start today's session, we're going to look at this practical illustration with respect to Fimponomics Bank. You know what bank stands for? Bank holds risk assets. And the risk assets of banks are financial instruments, be it a loan, bank overdraft, commercial papers, bankers' acceptances, and etc. Okay, and those are the things we are going to look at today. And we're going to look at it with respect to subjecting them to the requirement of IFRS 9 on impairment of financial assets. Now, because of the network issue, I believe Shegun is with the laptop now. And since you are with your laptop, I will give you the floor for you to read out the question. And as he read out the question, where practicable, let us highlight, underline, because all of those things are critical to our discussion today. Over to you, Shegun.
Okay, thank you very much, sir. Fimponomics Bank is applying IFRS 9 for the first time in its December 31st, 2019 financial statements. The following is information about its member loan portfolio at December 31st, 2019. Loan 1 to 4, as well as all of the loans in Group A1 and A2 share similar risk characteristics. They are mortgage loans in the same geographical area, which are all secured by collateral. Is it possible to increase the size? Okay, thank you. Okay, loan 1 to 4, as well as all of the loans in Group A1 and A2 share similar risk characteristics. They are mortgage loans in the same geographical area, which are all secured by collateral. All of the loans were originated at a market rate of interest. Fimponomics is unable to rebut the presumption that its loans have experienced a significant increase in credit risk when more than 30 days past due. Fimponomics considers all loans over 90 days to be credit impaired based on historical experience with recovering the associated debt. The aging of Fimponomics loans and the split between fixed and variable rates mortgages are as follows. On December 31st, 2019, we have Group A1 fixed rate mortgage and Group A2 variable rate mortgages. The total for Group A1 is 1.7 million, while that of Group A2 is 600,000. The current is 1.4 million for Group A1 and is 500,000 naira for Group A2.
Okay, sorry, stop there. Do we understand what they mean by current? Which means out of that 1.7, 1.4 million of it have not fallen due. They are still good loans. They have not fallen due.
Yes.
Why out of 600, 500 have not fallen due? Going forward from the table, other information to be read by Shegun with respect to 75, 100, 125, 20, 30, 50 are portion of that 1.7 that has fallen due, but has remained unpaid as at that date. Continue.
Okay, for group A1, 75,000 naira at past 30 days and 100,000 naira at past 60 days, while 125,000 naira at past 90 days. For group A2, 20,000 naira at past 30 days, 30,000 naira at past 60 days, while 55,000 naira at past 90 days. So the total for the total is 2.3 million. Current is 1.9 million. Total for more than 30 days past due is 95,000 naira. Total for more than 60 days past due is 130,000 naira. Total for more than 90 days past due is 175,000 naira. The Finponomics Treasury Department forecasts that interest rates will increase by 1% over the next 2 years. Based on historical data, Finponomics knows that a 1% increase in market interest rates usually results in a significant increase in credit risk for 10% of the variable rate mortgages that would otherwise be in stage 1. Finponomics monitors certain loans more closely on an individual basis, given their significance and unique characteristics. The following information is available without undue cost or effort on an individual loan basis. Please kindly scroll down, sir. Okay, we have 4 categories of loans: fixed rates, okay. For the first category, the amount is 200,000. The past due status is 90 days. Other information is the borrower has filed for bankruptcy. The present value of expected future cash flow is 180,000 naira with 100% probability of default. For the second category of loan, the amount is 150,000 naira. The status is still current. There's no further information and no present value calculation. The third category of loan, the amount is 120,000 naira. The status is current. Additional information is that the borrower has breached several other covenants within the loan agreement and was recently arrested for embezzling money from his employer. The present value of expected future cash flows is 120,000 naira. So the last category of loan amounts to 50,000 naira and the status is 60 days past due. Further information is that the borrower recently lost his job due to an economic recession and was granted a concession to skip payments. The present value of expected future cash flows is 37,000 naira, 100% probability of default. Additional information for group A1 and A2, taking into account historical information, current conditions, and forward-looking information, including actual loss experienced and recoveries from the sale of collateral, is as follows. Probability of default in the next 12 months, fixed rate loan is 2%, variable interest rate loan is 1%. Lifetime probability of default, credit impaired loan is 100%, not credit impaired loans 5%. Loss given defaults for all loans is 25%.
Thank you very much.
You're welcome, sir.
Okay, I believe we have the question. We'll now pair it side by side with the suggested solutions to that question. But I think I want us to emphasize something here. Here, they've told you that we have loans 1 to 4. Loans 1 to 4 are these loans here. Okay, and second categories are group A1 and group A2, which deals with mortgages. Only that one is fixed rate mortgage, the other one is variable rate mortgage. Okay, now how do we do that? Which means we are trying to compute impairment loss for 6 categories of loans, 1 to 4, and group A1 and group A2, which is 6 in all. Let's pick them one by one. We start from specific test for impairment, which means for those with loan 1, 2, 3, 4, which are individual loans. Let's start with loan 1. Who can interpret this question? Loan 1 is a fixed rate loan. What it means is that it's a loan where if you collect 1 million naira, your interest rate is fixed from beginning to the end. Now, the information here is that the amount of the loan is 200,000, but it's already past due 90 days. Now, if it is past due 90 days, and there's an expression here that says Triponomics is unable to rebut any presumption regarding significant increase in credit risk and every other thing, it means that from our principle of IFRS 9, any loan that has passed due 90 days with respect to interest or principal or both will qualify at what stage? Based on general approach, what stage would that be? Stage what?
Stage 3.
Stage 3. Now, stage 3 is a credit impaired stage. Abi? Now, the borrower has filed for bankruptcy. That has also corroborated our position. Now, what happened in that case? Even though we have done the present value of expected future cash flow to be 180, and the information regarding probability of default for this specific loan is 100%, probably because of the bankruptcy status. Therefore, what is the implication? The implication is that we have first of all identified that it's stage 3. And in stage 3, which is rationale for stage 3 because it is credit impaired, 90 days past due, and also the borrower has filed for bankruptcy. Okay, what then do? We recognize a lifetime expected credit loss. Now, if you check, the present value of what we can recover from the collateral and etc. is 180. But how much is outstanding? Exposure of default was what?
200,000 naira.
That's the kind of amount of default, 200,000. When you can recover 180 at current value from 200, therefore your exposure here, which is likely going to be your loss given default, is what?
It's 20,000.
20,000. What it means is that this 200,000 is already bad debt, but because you have the collateral, and by the time you sell the collateral in current terms, it's 180. Therefore, what happens? What you have as possible loss is what? 20,000. But you need to apply the probability of default. And in this case, probability of default is 100%, which means from your experience has shown that any company that's entered bankruptcy, anything you don't get from your collateral, you might not likely get from realization of other floating assets. Therefore, the 100% on that 20,000 still give you 20,000. That simply gives us the ECL for this first category. The second category of the loan is also a fixed rate loan, but the loan amount is 150. This is current. Current means it has not fallen due, and there's no other information that can prove otherwise. And that's why we have not calculated this. What it simply means is that this current one, which is 150, has no significant increase in this. It then means that we need to move it on a collective test basis. What is a collective test basis? We look for other categories of loans that falls under the same level 1. Level 1 means there's no significant risk, and we can now compute our ECL model on a collective basis, which means we'll now take this and add it to this category 1 of fixed rate loan. And what part of the category are we going to add it to? The 1.4, because this 1.4 are also current and not any of this. 1.4, and that is that position for that. Okay, now let's look at the third category. 120 is what was borrowed or what was outstanding. Current, which means there's no significant increase in credit risk, but there's an information here. And how do you treat this information? The borrower has breached several other covenants within the loan agreement and was recently arrested for embezzling money from his employer. Now, are you going to say there's no possibility of expected credit loss? given that he has even been arrested by the employer, which means probably he's using his salary to pay. With that arrest, can an employer still continue to pay salary of somebody that has been arrested by the same employer on the premise of fraud?
No.
Huh?
No.
No.
No. Therefore, it means even though it is current, there are more or less other factors, qualitative factors that need to be considered. And what happened at that level? Significant increase in credit risk, which means he has got into stage 2. Not because of, it's not because that, though it is current, but because there are other qualitative factors that may affect it in the future. His credit risk has deteriorated. And therefore, if his credit risk has deteriorated, what we have found out is that the collateral he presented, its present value is 120. And what is owing is what? 120. It means it is 0. That is our potential loss. And what is the probability attached to that also is 100%. Therefore, this is 0. Okay. Next one is category 4. The loan balance is 50,000. This has passed due 60 days. The borrower is recently lost his job due to an economic recession and was granted a concession to skip payments. Now, his collateral has been present value at 37,000. But the probability of losing this, of losing any other amount in excess of that collateral is 100%. Therefore, what happened in that case is stage 3. Why? Even though it is 60 days, which will have fallen under stage 2, but this factor here is much more pressing than this. Why? Because someone that has lost job, I don't think that person can immediately get job, which tells me that it's likely to be in a severe position. Okay, and therefore what happens at this stage 3 is for us to recognize lifetime. And it is the amount he owes, 50 minus the amount we can recover, which means what we are exposed to lose is the difference between 50 and 37, which is 13. And what is probability of losing it all is 100%. If it's 80%, it will have been 80% times 13. But 100% times 13 will still give you what? 13. Therefore, this is subjecting loans or financial assets to test on individual basis. Now, those that have not resulted into impairment loss on individual basis, or they have not been tested for impairment loss on individual basis, will now be tested for impairment on a collective basis. Now, what does that mean? One of the examples is this 150, which will now be tested on a collective basis with group 1. Group 1 are those ones that, group A1, we have those ones that are current. And this 150 also is current, and we have not tested it. Therefore, it means we can combine them together. Also, on the premise that something was said here that all of the loans were originated at market rate of interest. And secondly, that they are mortgage loans in the same geographical area which are all secured by what? Collateral. Which means we're also told that loan 1 to 4 and this share similar risk characteristics, which then means that on that premise, this 1.4 and this 150,000, which was not subjected to individual tests, will now be grouped together here. Grouping it together means we now have 1.5550, and it belongs to stage 1 because all current, all loans that have not passed due falls under stage 1. Now, stage 1 means you have to recognize 12-month expected credit loss. Now, what is 12-month expected credit loss? From the information here, first, for fixed rate loan, the probability of default is 2%. Okay, and since it is not a lifetime, therefore, this will not apply. And what is the loss given default? 25%, which means 2% and 25% is key for us here. Therefore, we now have this 1.550. The probability of default is 2% of it. And when it's at default, the loss given default would not be more than 25%. And which means on this sum of 1.550, the maximum loss we can record is 7,750. Now, the next thing is under the group A1, we still have past due. We now need to ask ourselves, this 75,000 past due, more than 30 days past due, where will it fall? More than 60 days past due, where will it fall? More than 90 days past due, where will it fall? We are aware that if it is more than 30 days past due, except you can reboot it, it is said to have experienced a deterioration in credit risk, which means it has experienced significant increase in credit risk. Therefore, it means this 30 days and 60 days fall below 90 days. It is only when it's more than 90 days, except you have qualitative information, that it is presumed to have been credit impaired, which then means that 30 days and 60 days will fall under stage 2. And let's look at it. 30 days for group A1 and 60 days will fall under stage 2 because more than 30 days past due, therefore presumed to have experienced a significant increase in credit risk. And our requirement is that when it falls under stage 2, you still use lifetime loss. And under lifetime for group fixed rate loan, what do you have? 2% is probability of default, but for a lifetime probability of default, if it is credit impaired, which means stage 3, it will be 100%. But if it is not credit impaired, which means stage 1 or stage 2, it will be what? 5%. Now, 5%, 2%, and 25% will be relevant for us. And in that case, what do we have? We have 175,000 times 5% and times 25 what? Percent. Do you get what I'm saying now? And that will give us our position of 2188 as the portion of 175 that is provided for as a credit loss. If you have any question, please kindly raise your question. Okay. Now,
but why didn't we use that 2%?
The 2% is for probability of next 12 months. Why the lifetime is this? Remember, 12 months is different from lifetime.
Yes,
that's why the categorization is key. If you categorize it wrongly here, it then means that your input, your variables will be wrong also. Okay, now let's look at this.
Sorry,
the final
I have a question, sir.
Yes.
Sorry, that 2% probability that we put there, is it a company policy that we state that, or what is the determinant of that 2%?
Okay, the determinant is as follows. Look at it. What are the determinants? Additional information for group A1 and 2, taking into account the following: historical what?
Information.
2, current what?
Current conditions and forward-looking information.
Including what?
Including actual loss experience and recovery from the sales of collaterals.
Now, let me share our material to you based on what we have discussed before now. Measure expected credit loss. Can you read this out? No, okay. You ask the question.
Measuring expected credit losses. Credit losses are the present value of all cash shortfalls. Expected credit loss are an estimate of credit losses over the life of the financial instrument. An entity should consider the following when measuring expected credit losses. Expected value. The probability weighted outcome. Expected credit losses should not be a best or worst case scenario, but should reflect the possibility that a credit loss will occur and the possibility that it will not. Time value. The time value of money. They should be discounted at the reporting date. date and information, historical,
Data,
current, and future.
data, not date.
Reasonable and supportable. Sorry, data and information, historical, current, and future. Reasonable and supportable information is available without undue cost or effort, including information about past.
Now, historical, current, and what? Future. All of these are what form the basis, and it's scientific. And that is how they arrive at that, not just mere saying 2%. And take note, it is 2% this year. Next year, it might be 1.5, it might be 3% based on new information and changes in economic or macroeconomic variables. Does that answer your question now?
Yes.
Okay. Now, let's look at the final category in Group A1, more than 90 days. This 125 will go to stage 3, except if there are superior information that retain it as stage 2. And in this case, it is stage 3. Why is it stage 3? Because it has stayed over 90 days. And we have to recognize lifetime. And under lifetime, what do you need? This lifetime, this is 12 months. Lifetime probability of default. If it's stage 3, it is credit impaired, 100. If it's stage 2, it is not credit impaired, 5%. Therefore, what do we pick? 100%, Abby, and we have 25% discount. Therefore, you come here, 100% and what? 25% of this present value amount.
You're not showing your screen.
And that is that. Okay, sorry. Thank you. Now, I said from the information we have here, the 125 is more than 90 days. Therefore, that means more than 90 days will fall under category 3 or stage 3, and that is lifetime. And lifetime has the following information. Because it is lifetime stage 3, it is 100%. But if it's lifetime stage 2, it will be 5%. But loss given default at every point in time for all the loans is said to be 25. We can vary also. But because this loan share common characteristics according to the information, probably that's why the loss given default is at the same rate of 25%. And that gives us 25%, 100% of 125. That's how we arrive at 31,250. Now let's go to stage 2, group 2. Group 2, group A2 are available rate loan. What is the current portion? 50. Okay, 50. Current portion 50. Now there's an information here which is key to us. Who can interpret this information? I want you to read it once again. Shegun, is Shegun there? Okay, if Shegun is not there, Nuruddin, can you read this statement once again?
Okay. The Economics Treasury Department forecasts that interest rates will increase by 1% over the next 2 years. Based on historical data, Economics knows that a 1% increase in market interest rates usually results in a significant increase in credit risk for 10% of the variable rate mortgages that would otherwise be in stage 1.
What is the interpretation of that? That if the market rate increased by 1%, it means the risk of default will increase by 10%. Does that make sense?
Very, very.
Because people already have probably a fixed cash flow, but now you're increasing interest rate. That means they might not be able to pay.
Exactly.
That's what it means. Therefore, how does that affect? I remember that group 2 are all variable rate mortgages, which means group 1 will not be affected because it's fixed rate. But group 2 will be affected because it's what? Variable.
Variable.
And that is why when you come here, you find out that the 500, which is current, now times 90% is what? 450. Is that okay? Now, the portion that will not be affected is this 90%. The portion that will be affected is 10%. Therefore, you now split it into 90 and 10, and I will explain. Now, the 90% means that 90% of the 500, which is 450, will not be affected, which means they have the ability to pay, while only 10% of them will not have the ability to pay. Which then means that 90% will still fall under stage 1, while 10% of them will move to stage 2, even though they are current, because that increase in future interest rates will make them default. Now, the 450 still maintains stage 1 at 12 month expected credit loss, which year it is. Now, remember, fixed rate loan probability of default is 12 months. For 12 months is 2%. While variable rate is what? 1%. Don't mix it up. Because the way default exists for fixed varies from the one that is not fixed. Therefore, it is 1% times 25%. 25% is our loss given default, which means in this case, this is 1,125. Now for group 2 are those that are in stage 2. And stage 2 includes 30 days and what? 60 days. Plus the 10% of this current that is likely to fall into stage 2. Remember, it is expected credit loss model, which means it's not until it happens. Once I see that you are likely going to default, I take you to the next bucket. I won't wait until you default. That is the difference between incurred loss, which was IAS 39, and expected loss, which is IFRS 9. Therefore, it means there are 3 categories that falls under stage 2. First is the 20,000 for 30 days. Second is the 30,000 for 60 days. And third is the 50,000 from the current, which is attributable to possibility of increase in the interest rate that will bring about 10% of them falling into a default zone. And that is 20 plus 30 plus 50,000 will give me 100,000. And they fall into stage 2. And in stage 2, it is lifetime, no longer 12 months. Lifetime, and because they are not credit impaired, because they are not in stage 3, it is 5% plus 25%, which means 100,000 times 5% times 25% will give us 1,250. Why the last group is the 50,000 for variable rate mortgages, which is more than 90 days. And they fall under credit impaired 100% and loss given default of 25%. And that's how we have stage 3 credit impaired, and you recognize 25 100% of 50. And that is that. When you add everything together, what are we adding together? The 20, the 0. Now, this is 0 signifies that even when you subject an asset to impairment, whether stage 1, 2, 3, it may have impairment loss that is 0, which means not compulsorily must he have 1 naira, 2 naira, 10,000, 1 million as impairment loss. It could be 0. It is 0 when all what you can recover is even far, far more than what the person is owing, because you owed more of asset of that person than much of the liability of that person. Do you get what I'm saying? And that is what this tends to explain to us. Now, aggregately, we have 20,000 is 0, 13,000, 7,750, 2,180, 31,250, 1,125, 1,250, and 12,500. All of this is what we call total impairment loss under IFRS 9, which you call the expected credit loss of 89,063 naira. And that is that. In this situation, reasonable and supportable information on credit losses and collateral was not reasonably available without undue cost or effort on all individual credit impaired loans, because it comprise a large number of small loans. Therefore, each year are measured on a collective basis. On what are they measured on collective basis? Remember, these are done on a collective basis. Instead of you singling out each, each customer. Each customer is for those that are significant and you can separately identify them without onerous costs. But others, you group them based on economic characteristics, geographical characteristics, or any other demographic characteristics that make them homogeneous. Okay, and that is that. That's what we're trying to say there. In other situations, it may be possible to estimate each year for individual credit impaired loans, which we have done for loan 1, 2, 3, 4. The same applies to estimating whether there have been a significant increase in credit risk or not. Now, does this expatiate further what we have been talking about? And I want you guys to any questions on this?
I don't have any question, but this last exercise seemed to me like the practical one, the practical aspect of what we've been doing so far. It seems like what is obtainable on field, I mean, in companies. So it's really very clear to me, and I appreciate that.
Okay, thank you. Any other question? Okay, in the absence of no question, I'll give you guys 5 minutes to look at it from home. You have the materials and everything. We can now move to the next discussion, which is on embedded derivatives. Okay, well, welcome back to the session. And now we'll be talking of embedded derivatives. Now, what is embedded derivative? The first thing you need to know about embedded derivative is that it is a host contract that has derivative embedded in it, which means it's a form of a hybrid contract. Similarly, we discussed hybrid contract under IS-32, where we said it has the features of 2 components. Now, similarly, in this case, it's a hybrid contract that can be considered as a compound instrument, where you need to separate the host contract from the derivative embedded in it. But there are conditions attached to embedded derivative that will give us a leeway towards accounting for it appropriately in line with the position of IFRS 9, which slightly differ from IS-39. And we're going to look at it carefully. Now, embedded derivative is a financial instrument that is combined with a non-derivative host contract to form a single contract, which we call a hybrid instrument. Now, one thing we need to understand about this is that IFRS 9 makes us understand and appreciate for simplicity the following. Where the host contract is an asset within the scope of IFRS 9, the hybrid contract is accounted for as a single instrument. And we're going to see that as we move on. Otherwise, in line with IFRS 9, embedded derivative will be required to be separated from the host contract where certain conditions are met and accounted for separately. I'm going to explain that. Now, but let's start with what is a host contract? When you talk about host contracts, you are talking about a normal contract that exists within an organization which conventionally such an organization transacts on a normal basis. Typical example of host contract is when a company enters into a lease arrangement, or what we call a lease agreement. Lease in this case, whether as a lessor or as a lessee, is a host contract. When you enter into a construction contract, either as a contractor or the contractee, this is a host contract. Host contract simply means normal contracts between an entity and a third party other than a derivative contract. It could also be a contract which is more or less like a repo, sale and repurchase agreement, which might be for financial instruments and can also be for normal assets. It can be an insurance contract. And you all understand what insurance contract is. Insurance contract has an underlying pool of interest, what we call the insurable interest, in which one other party tends to assume those risks on behalf of other parties. It could be a normal contract, which is a financial instrument that creates either a debt instrument, which is a financial liability, or an equity instrument. All of these are examples of a host contract. But where derivative is attached to this contract by way of hedging inherent risk or financial risk embedded in such a contract, such contract is now commingled as one, which makes it a hybrid. And such contract is what we call embedded derivative. Now, when you have all of these host contracts in which you write derivative on them, therefore you create what we call embedded derivative contracts. I'll give you practical examples of these contracts. Practical example of this contract could be a situation where you have, let me say you have a bond that is redeemable in 5 years. Whereas the redemption price is attached or is tagged or pegged to a particular market factor, such as index, market index, such as inflation, such as interest rate or any other market variable. Such is considered embedded contract, embedded derivative contract, because you have attached derivative to it to hedge against risk that you may be exposed to in the future. In that situation, the host contract will be the bond itself that you have issued, while the derivative that is embedded in it is the option that is attached to it, either option on equity, either option on interest rate, or option on any market variable that is so attached to it. Another one that is common is that whenever you enter into a construction contract in a foreign currency, that also could create embedded derivative. Why? The construction contract itself is a non-derivative contract, which is the host contract. Why the foreign currency exposure that is embedded in it in order to hedge against volatilities may qualify as an embedded derivative, which is a derivative that needs to be separated where practicable from such a host contract for the sole purpose of its accounting. That is an example. There are some other examples that I've more or less shared with you on your WhatsApp platform. And let me share that on the screen here. These practical examples also were obtained from Deloitte IGAP of 2019. I want somebody to read the first one and let me explain it.
Okay, I will read. Entity X issues a bond that is convertible into ordinary shares of entity Y. The hybrid contract is a convertible bond. The host contract is a bond liability, and the embedded derivative is a conversion option.
Which is the reason why under IS 32, for compound instrument, we split it into two. The bond aspect, which is the liability, and the equity option aspect, which is the equity instrument. We've done that example before, and we are just reiterating it here. Now let's look at the second one, lease contract.
Okay. Entity A enters into a lease with an inflation factor such that each year lease payments are adjusted for changes in a retail price index. The hybrid contract is an entire lease, the host is a lease contract, and the embedded derivative is the adjustment to the retail price index.
Now, if you get to IFRS 16, what we'll be discussing lease, you'll find out that one of those things that you don't consider in determining your present value of the minimum lease payment is contingent rent. Now, contingent rent will be measured separately from the lease contract. Why? Because the contingent rent is the changes that could arise from the retail price index movements. And in that situation, you must always separate the lease contract from the embedded derivative, which is the indexing of the minimum lease payment to the retail price index, which is also called the inflation rate or inflation. And in that situation, you find out that this is one of the reasons why when you get to IFRS 16, where you are told to not to consider contingent rent in the determination of your, because it has to be measured separately in line with the relevant standards from IFRS 16, which deals with leases on its own. Another one, yeah.
Okay. Entity T, a UK entity whose functional currency is sterling, enters into a contract to sell a non-financial item in US dollars. The hybrid contract is the entire sale contract, which will be settled in US dollars. The host contract is a sterling sale contract. The embedded derivative is the foreign exchange pounds to US dollar forward contract.
Okay, what they are simply telling you here is that you are a UK company. Everything you do, what determines your cost, what determines your selling price, what determines every factor surrounding you is UK sterling, pound sterling. But in this case, you are selling your assets to a third party and you are selling it in US dollars. What you have simply done is that you have done two transactions in one. Due to the volatility of pounds, which means pounds may suffer some economic loss, you try to hedge your risk by selling in dollar. Pick it in Nigerian context. Instead of selling your product in Naira, you are selling it in dollar. What are you trying to do? Is that one, you are selling. Two, is that money, you want it in dollar because dollar is a more stable and preservation of value than Naira. Are you getting it now? That's why you find out that in Nigeria, people prefer to sell what they produce outside Nigeria than selling it in Nigeria. And those are the factors that make things expensive in Naira. And therefore, what have you done? You have done two things in one. You are in the business of selling. You sold. That's on one hand. On the second hand is that the money you have realized that's supposed to be in Naira, you try to realize it in dollar in order to hedge against your risk of loss of purchasing power. And therefore, it means the host contract is a sale of goods. The derivative embedded in it is a forward contract that you have entered into with respect to the exchange of Naira with dollar, which in this case, pounds with dollar. Look at it in that sense. And that's what we are trying to say. Let me see whether I can have more examples. Okay. Okay, let's look at this also. Can you read this?
Okay. An entity A issues floating rate debt. To protect itself against rising interest rates, it purchases an interest rate cap, capping interest payable at 8%. The cap is contractually separate from the debt so that it is not an embedded derivative, but a standalone derivative. An entity A could have instead issued floating rate debt, where the debt instrument itself is capped such that once interest rates rise above 8%, interest payable is restricted to 8% until rates fall below that level. In this case, there is an embedded derivative within the debt, that is the interest rate cap, and this cap would need to be assessed to see if it should be separately accounted for.
Now, I've shared some documents with you if you want to have better knowledge on derivative. Derivative is a field on its own, okay? And when you hear interest rate cap, interest rate floors, what it simply means is that interest rate cap says that this is the maximum interest rate I can pay. Anything above it, I might not be able to pay. Therefore, what you have to do is that you enter into a contract so that once anything is above it, you'll be compensated for additional interest you pay, which means you buy an option for that, okay? Or you enter into when it's interest rate floors, which means interest rate cap is majorly from the angle of a borrower. When you borrow under a variable interest rate loan regime, because interest rate will be moving with market. Therefore, you now believe that, okay, even though it can move, anything that moves beyond 10%, I might not be able to fulfill it. Therefore, you buy an option to cap it. That's what we call interest rate cap. Okay, the option is that anytime interest rates fall above certain level, therefore somebody must pay you for that differential so that you can be able to fulfill your own obligation. Floors is from the angle of the lender, because again, the lender also have exposure that if I lend you money on the basis of variable interest rate loan, once the market rate continue to fall, it will fall to a level where it cannot compensate me for the cost of borrowing, especially if I borrow at a fixed rate loan or I'm using equity to lend you and the equity has a cost of capital which is higher than that rate. At the end of the day, I need to protect myself. Therefore, I buy an option so that anytime interest rate fall below the floors, I'll be compensated in order to meet up my own obligations. And that is that. Now, what has happened here is that scenario one is that that entity decided to, instead of cap it as a single instrument, it now enter into a derivative separately. In that situation, that's not embedded derivative, which means you have a derivative contract separately, which is used to hedge your exposure. When we get to hedge accounting, we'll say that. But embedded derivative is the second scenario, which says that in that singular bond, you say, this bond I'm buying, yes, interest rate is variable. I'll continue to pay interest trade variable up to the level it gets to 8%. Anything above 8%, you cap it. I can't pay it. Do you get it now? And that is what you are trying to do. So that when it now falls below again, you start to pay below 8%. But at no point can you pay more than 8%. In that case, you've had embedded derivative, which means one thing is you have a loan, which is a financial instrument for the sole purpose of its nature as variable interest rate. You continue to pay interest within the range of 8%, but anytime it's more than 8%, you cap it at 8%. And in that case, what you have to do in your measurement is to consider it as an embedded derivative. Now, since we know what we mean or what we need to understand as embedded derivative, the next question is, how do we account for embedded derivative? Now, to simplify it, the accounting is in two folds. First is, should we account for it, both the host contract and the embedded derivative as a single contract, or should we account for them as separate contracts where we apply relevant standard to it? And the standard is so clear. Okay. Now, let's look at it. If the host contract is a financial instrument, which falls under the scope of IFRS 9, in that situation, the entire measurement rule, the entire instrument will be taken as one. That is, you treat it as a single instrument. And in that situation, you measure it at fair what? Value. But again, there are exceptions to certain rules as a way of simplifying the requirement of IAS 39. And one of those things is this. When it comes to host contract that is not a financial instrument, what you need to take note of is that 3 conditions is required to be satisfied for you to separate such host contract from that financial derivative. And when you separate the host contract from the derivative contract, you will measure the host contract in accordance with its standards. If it's construction contract that's entered into foreign currency, the construction contract itself will be accounted for under IFRS 15, revenue from customers, from contract with customers. And while the foreign exchange exposure of it will be accounted for as a derivative in line with IFRS 9 at fair value. Okay, that is if you separate. But the condition is that before you separate, certain conditions must be met, and there are 3. Otherwise, if those conditions are not met, you can't separate. You have to commingle the 2 contracts as a single contract and measure them at fair value. How do you do that? Now, the first condition is this. You consider the economic characteristics and the risk embedded in that contract if it is similar to that of the embedded derivative, which means the question is this: if the economic characteristics and risk of the embedded derivative are similar to that of the host contract, it means you cannot separate. But if they are not similar, that is, they are not closely related, it means you can separate. In addition to that, you must also consider that if you separate the derivative contract, is it such that that embedded derivative will have met the definition of derivative contract on its own? The reason being that not necessarily can you consider the derivative embedded in it to have qualified as a derivative contract under IFRS 9. Remember, not all derivative contracts are within the scope of IFRS 9. Those that are within the scope of IFRS 9 are derivative we consider as financial derivative because they are net settled in cash.
Okay.
Lastly, you must consider that the hybrid instrument will not be required to be measured at fair value. What it means is that if the host contract is to be measured at fair value to profit or loss, and the derivative itself will be measured at fair value to profit or loss, therefore, why separate them? Therefore, you have to commingle them as a single contract and measure them at fair value to profit or loss. But if the host contract, even being a financial asset, will have to be measured other than at fair value to profit or loss, but the derivative will be measured at fair value profit or loss. Therefore, there's a need to separate the two contracts. And that is what the position of the standard is. Any question on that? Any question on that?
Please, I would just like you to put more light on that number 2. I understand the first and second, but the first and the last, but the second is not too clear to me.
Now, what we are saying is this. If you say you have embedded derivative, it means you have host contract and you have derivative embedded. The question is the derivative embedded in it. If you take it as a standalone contract, does it meet the definition of derivative contract under IFRS 9? Okay. And I now reiterated that under IFRS 9, certain conditions should be met for it to qualify as a financial derivative under IFRS 9. Or because commodity derivatives that are not settled in cash, that require physical delivery of that commodity, will not be measured under IFRS 9 because it's a pure non-financial derivative. That is what it means. For example, let me take us back to when we discussed about derivative. Okay, there are some attributes I think I shared about derivative. If it's not here, it will be in the notes that we highlighted. Okay, I think it's there. Now, can you read the features of a financial derivative that falls within the scope of IFRS 9 or within the scope of IAS 32 and IFRS 9?
Okay, a financial instrument or other contract with all 3 of the following characteristics. Its value changes in response to the change in a specified interest rate, financial instrument price, commodity price, foreign exchange rates, index of prices or rates, credit rating or credit index, or other variable, sometimes called the underlying. It requires no initial net investment or an initial net investment that is smaller than would be required for other types of contracts that would be expected to have a similar response to changes in market factors. And thirdly, it is settled at a future date.
That is it.
Okay.
And when it is settled, it's net settled. Let me add it to it. That is net settled in cash. Must take note of it.
Okay, sir.
Okay. Now we'll go to the final level, final discussion. Understanding the impact of IFRS 9 Hedge Accounting adoption. Now, for me to go into that discussion, the first thing I'll make you to understand is, what do you understand by hedge? In risk management, there are 2 key factors. Okay, we have what we call, let me try and share my notes so that I can write today. I think over time we've missed our writings.
So can I try to explain my understanding of hedge accounting?
Okay, now before we get to hedge accounting, I wanted to share, this is my pen, I'm trying to start from the financial risk management parts. Okay, because before now, under IS 39, there was less synchronization of activities with respect to risk management of organization and the accounting for it. But what IFRS 9 has tried to do is to more or less link the two together such that the accounting is a follow-up to the way and manner in which the organization manages its financial risk. And that's why I want to start from that approach rather than just talk about hedge accounting, because people still misconstrue what it is in its real life. Okay. Okay. Sorry, I'm trying to set up my pen. Okay, I see my pen want to write under separate condition. Okay. Now, under financial risk management, there's a thin line between hedge and speculation. Where we have hedgers and we have speculators. Now let's start from this. Shegun.
Okay, sir.
Can you give me a clue about what is hedge and what is speculation? And who are hedgers when it comes to hedging, and who are speculators when it comes to speculation?
Okay, it's all right. I can say the person that is hedging maybe someone that has commodity, but believes that after a certain period of time, the price of that commodity will rise. I mean, will fall, and the person wants to prevent against that risk of the price falling. So we can say that person is a hedger because he's entering into the contract to prevent against further fall in the price of the commodity. Why a speculator would think maybe looking at the macroeconomic variable, he believes that the price is going to rise regardless. You understand? He is speculating that the price is going to rise. So the speculator can enter into a contract with the hedger, and it depends on where the ball swings eventually. If the price of the commodity rises, then the speculator will have more money. But if it falls, then it means the hedger is in a better position because they are prevented against such situation. So that is just how I can
Okay,
describe
which means from your summary, you can't have a hedge without speculation. That is, there can be a hedger where there's no speculator, because hedge deals with avoiding risk or reducing risk or eliminating risk. While speculation is about taking up those risks for profit. Is that your conclusion?
Yes.
And therefore, which means you can't have an insured without an insurer. You can't insure your car if there's no insurance company that's ready to take the risk from you.
Yeah, that is it. And in the end, one person must win and the other must lose.
Now, which means if we say we can't have hedge without speculation, can we have speculation exchanging with speculator? Which means there must be speculator for hedge to take place, Abi?
Yes.
But can there be speculation without hedger? Which means two speculators can deal with one another, depending on the perspective of the risk.
Yes, it's possible because I think even the person hedging is also speculating in some way.
Okay, the person hedging is real sense is not speculating. It's trying to eliminate risk attributed to uncertainty in direction of what is coming, or in the magnitude of what is coming, even if he knows the direction. But again, today, speculation accounts for the significant portion of derivatives. Whereas primarily derivatives were designed solely for the purpose of trying to use it as an instrument for hedge. Now, let me show you something now. Let me share something before we proceed. Can you read this from Investopedia?
Okay. Speculation involves trying to make a profit from a security's price change, whereas hedging attempts to reduce the amount of risk or volatility associated with a security's price change. Hedging involves taking an offsetting position in a derivative in order to balance any gains and losses to the underlying asset.
Thank you very much. Therefore, we'll come back to this to say, when you hedge, mostly you hedge with derivative instruments, but not in all cases do you hedge with derivative instruments. You can also hedge with any non-derivative instrument that can qualify as a financial instrument. I will explain when we get somewhere. How can you hedge with a non-derivative? Okay, as we move on, there are certain key things you need to take into consideration. The first thing is, what is hedging from accounting perspective? Hedge accounting is a voluntary accounting. It is a voluntary accounting because IFRS 9 does not mandate any company that has entered into a hedge to adopt such accounting. Which means if you have entered into a hedge with a derivative instrument and you did not apply hedge accounting principle, what you are simply doing is that the derivative contract will be measured separately at fair value, and the impact of that derivative will immediately affect your profit or loss in that period, without waiting for the impact on the actual contract or instrument which you have hedged, which you call the hedge item, to crystallize. But because this practice creates more of accounting mismatches, I'll give you an example. I hedge against volatility in the price of what I have committed to buying in the next 2 years, aeroplane. The aeroplane will be purchased in dollars, but I produce and sell in what? My own product in Naira. Which means even if we've had a firm commitment that I'll buy the aeroplane for $5 million, the challenge there is that the $5 million today at 480 Naira will be different from what the $5 million will be at probably at 600 Naira in 2 years' time. The challenge there is that I then need to hedge by entering into a futures contract to buy dollar at a particular rate, let's say 500. The issue then is that if I enter into a future contract, every reporting date, the movement in the future contract will impact my profit or loss, I gain or profit or loss. But the hedge item impact has not yet crystallized until the end of year 2, which then means that I'm already creating volatilities in my profit or loss. And that creates more of accounting mismatch. And to reduce the accounting mismatch, that is why the hedge accounting, which is a voluntary accounting, was created so that you can adopt that if you know that you want to take away such volatility out of your profit or loss, so that you can appropriately match the gain that comes from the hedge instruments against the loss that comes from the hedge item, or vice versa, the loss that comes from the hedge instruments against the gain that comes from the hedge item, so that they are meeting themselves in profit or loss. And when they meet themselves in profit or loss, given that it's a perfect hedge, the difference between the gain and loss from the opposing side would be so insignificant or immaterial to have created volatility. And that is the sole objective of IASB in the introduction of hedge accounting. But again, it's a voluntary accounting. It is voluntary for you, and it is usually adopted by those companies or entities that tends to remove volatility of their hedging affairs from their profit or loss until it actually crystallizes along with the hedge item. The question then is, what is a hedge item? A hedge item can be an asset you have, which you control, or can be a liability you owe by way of present obligation, or can be a firm commitment. A firm commitment is, for example, what I told you. You have committed with Boeing or Airbus to buy a plane for $5 million in 2 years' time. That's a firm commitment. Or any form of forecast transaction. Forecast transaction is opposed to firm commitment, which means you want to get something in the future. I want to do MBA, PhD in Harvard in 2 years' time. I've not committed with Harvard, but I have that intention, which then means that I know that doing PhD in Harvard might cost me $200,000, but the Naira value will change based on the Nigerian situation, and I earn Naira. Therefore, that's the forecast transaction which I equally wanted to hedge without necessarily yet committing to Harvard that I must come there. Therefore, These are what we call hedge item. And such hedge item is such that even the forecast future transaction that you as an entity is exposed to by way of changes in market fundamentals of variables, which can be market prices or variability in your future cash flows. And in this situation, we call any of these items a hedge item. Your hedge item might be the inventory you hold in stock. Your hedge item might be your collection with respect to receivables in foreign currencies, can be your loan you have in foreign currency, can be anything that has risk, financial risk inherent in it. Risk of market factors such as changes in market prices, changes in interest rates, inflation rates, foreign exchange rates, and some other market dynamics. That is what we call the hedge item. That is the instrument you want to hedge. That instrument you want to hedge is instrument that carry financial risk that you cannot bear, but you need to transfer, reduce, or avoid. The second thing then is hedge instruments. Hedge instrument then is either the derivative you have written on that hedge item in order to take offsetting position of it. What it simply means is this: the hedge instrument will take an offsetting position of the hedge item, because let me use a simple analogy. If before the match between Arsenal and Chelsea, you have already put up a bet that Arsenal will win Chelsea, unknown to you that two key players in Arsenal has had injury during the training session, and they've announced that these two players will not play, and you have already set up a bet. Now, you don't want to take the risk going forward because it is unlikely that with those two players not playing, Arsenal will win Chelsea. Therefore, you now went to a third party that was not aware of your side and say, Chelsea will win Arsenal. You look for another Arsenal fan that is gullible like you initially. I say, okay, Chelsea will beat Arsenal. That says, no, you can't beat. Okay, you now set up a bet with that other person, which you call a counterparty. And that person enter into that bet. Let us assume you have already bet 1 million naira before now. Now you are taking your opposite position to bet 1 million naira. That is a perfect edge. When Arsenal is playing with Chelsea, you are less bothered. If you take away loyalty as a fan, you are less bothered about who wins, because at that point in time, your mind is at rest. If Arsenal wins, the only regret is that, why do I go and take counter offer? But you didn't lose anything. And if Chelsea wins, you will have thank God I went to quickly get an opposing position. Therefore, the question then is, the hedge instrument is the offsetting position you have taken, which is usually taken by way of derivative. And in extreme case, it is also taken by non-derivative financial instruments, which we are going to see. Which then means that in simple terms, a hedge instrument is a designated derivative, or in limited circumstances, another financial asset or another financial liability whose fair value or cash flows are expected to offset changes in the fair value or cash flow of the designated hedge item. That's why I call it opposing or offsetting position, which is the analogy I gave to you with respect to taking the initial bet and taking the second bet to counter it or to neutralize it. And that is that. Now, take note of this. A non-derivative financial asset or liability may be designated as hedge instrument for hedge accounting purposes only if it is to hedge against foreign exchange risk. That's only when. And I'll give you a practical example when we get to the third type of hedge, because we have three types of hedge. The third type of hedge is the hedge where financial asset or liability is permissible or permissive as hedge instruments other than a derivative contract. Okay, that is that. Now, what is key in my analysis I gave to you earlier is issue of perfect hedge and hedge effectiveness. Now, what is perfect hedge? Perfect hedge is where you have exactly opposing position to hedge against your risk. And the example I gave to you about Arsenal and Chelsea, I set up a bet of 1 million, I counter it with another 1 million. There's nothing as perfect hedge as that. But you might also have a problem that you don't have a perfect hedge. Where does the problem come from? You set up a bet of 1 million naira initially that Arsenal will win before you realize that Arsenal now had 2 serious injuries. Now you now went to meet another counterpart to offset it. But unfortunately, the counterparty you met said, that the betting I want to have with you is 600,000 naira. The problem there is you still go ahead with it, but which means what you have hedged is just 60% of your 100%. Or conversely, that person said, no, it's 1.5 million, I want to bet. Now, what you are doing is you are now over hedging, which means you have hedged 100%, and you are now taking a risk of 500,000, which is another 50%. Which means in both two scenarios of 600,000 and 1.5 million, you have what we call a non-perfect hedge. But the question then is this from the standard. You will ask yourself, for me to have hedge effectiveness, I must define from my hedge documentation what portion of the risk of the exposure I want to hedge. And that portion is what you now need to define by way of perfect hedge. Remember, I might not be totally risk averse. I might say, okay, out of the 1 million I initially bet in favor of Arsenal, with this injury, I will prefer that I bet with 400,000 or I bet with 300,000. But that 1 million, it will be too brave for me to lose it because I never knew that 2 players had injuries. Therefore, if you identify 300,000 out of the 1 million as what you are ready to commit naturally, information was available to you before now, it then means that that 300,000 is what you want to hedge. Where you now have an offsetting edge to bet with somebody else for 300,000, is still a perfect hedge because IFRS 9 permits you to hedge a component or a part of a whole, which means it's not compulsory to hedge everything because I want to take risk of this of 300,000 or I want to take risk of 700,000. The other portion of it is what I want to hedge out. And that is that, which means you can hedge a component part and you can also hedge a portion. But the question is this, anything you so determined to hedge, for you to be able to apply hedge accounting by way of your hedge documentation, which precedes your application of hedge accounting, you must have demonstrated that there is a perfect hedge of that portion. And that is demonstrated through what we call hedge effectiveness, HE. Hedge effectiveness is the degree to which changes in the fair value or the cash flows of the hedge item attributable to the hedge risk are offset by the changes in the fair value or cash flow of the hedge instrument. Which means any portion I hedge, whether in part or in whole, the offsetting position I've taken, the gain or loss from it must match. When I say match, it's not necessarily 100%. Under IAS 39, the matching, let me share my note slide. Under IAS 39, the matching was given in the range of 80%. Hedge effectiveness is the gain or loss on hedge instrument to loss or gain. Remember, it's offsetting position on hedge item. Therefore, hedge effectiveness, HE, ranges from 80% to 125% under IAS 39. But rather, under IFRS 9, hedge effectiveness is when at least the gain or loss on the hedge instrument is significant and not more than 100% of the loss or gain on the hedge item. We are going to display this with illustration. Illustration will explain it better to you. But before now, under S39, what you use is if the gain from the hedge item represents or cover at least 80% or no more than 125% of the loss of the hedge item, it is effective. Okay, and that is what we mean by this. But under IFRS 9, what matters is for us to say if gain in hedge instruments is $100, and loss in hedge item is $100, then it is fully effective. Scenario 1. 2, if gain in hedge instruments is $100 and loss in hedge item is $90, then A, the effective portion is 90, which is this. And B, the ineffective portion is 10, being the difference between the 100 and effective portion of what? 90. Now, let me give you scenario C. If gain in hedge instrument, is 100 and loss from Hedge item is 120. We can say it is effective. Why we say that is that we rely on the requirement of IS 39 that gave 80% to this. Because when you find the ratio, what is the ratio of 100 to 120? That should give approximately 80 what? Percent. But again, this 80% that I'm relying on under IS 39 is not necessarily sacrosanct, and it is rebutable by entity based on how the entity has defined its hedge effectiveness. Some define their hedge effectiveness by running regression models and some other things. But again, to simplify it, I annex the provision of IS 39 to look at the effective portion. Okay, which means it's still effective. Now, let us now look at the final scenario. If gain in hedge instrument is $100 and loss from the hedge item is 140. We can conclude, except otherwise rebutted by the entity under concrete and scientific justification, the hedge is ineffective. It's ineffective because when you look at ratio 100 to 140, let me pick my calculator. Ratio 100 to 140 is 71%. Therefore, it is ineffective. Okay, that is that. But take note, there's a phrase I mentioned here that when at least the gain or loss on hedge instrument is significant, not insignificant, is significant, and not more than 100% of the loss or gain on hedge item. Anything above the portion that is the loss or gain will be considered ineffective. That is the example I've mentioned here, which means what I've mentioned here with respect to not more than 100%. Let me highlight it. Yeah, this aspect of not more than 100% is what this scenario 2 has given to us. Okay. If there's any question, I want you guys to ask now. Any question before we move further?
So just to clarify, it is only ineffective if the if the loss on the edge item is less than 100%. Am I correct?
No, not less than 100%. Can you see this number 3? It's less than 100%, but it's effective. Because I rely on the requirement of IS 39 because it's less than 100%, but not less than 80%.
Okay.
Yeah. Does that make sense, sir?
Yes, sir.
Okay. Now, let me take you back to our position. Now, there can be, you can't voluntarily adopt edge accounting if you have not met certain conditions. And the condition is that you must have prepared and agreed based on board commitment to edge documentation. To edge what? Documentation. Now, the question then is, what is edge documentation in this case? Edge documentation is to more or less document the entire process of your edge. And that process is to identify if actually what you seem to have edged qualify for the sole purpose of edge accounting. And it is from there you also have defined what edge effectiveness is and what your perfect edge is in terms of, are you edging a whole or a part of a whole or a component of a whole? Okay, now let me take you through a simple process. IFRS 9 contains a principle-based model for edge accounting that is solely aimed to align accounting with risk management activities of an organization, which is against or which is not in tandem with the position of IS 39, because IS 39 does not marry how company manages its financial risk internally based on internal models to how we account for it, which is accounting is doing its own, internal risk management section is doing its own. But IFRS 9 has tended to bridge the gap because of the collapse that happened between 2007 and 2009, which brought about the total demand for change in the process of accounting for financial instruments. And that was when the project started in 2009, 2010, up to when it was completed in 2015. And it took effect in 1st of January 2018. Now, what has now happened in that light is that there has now been a synergy between risk management activities of an organization and the accounting activities of that organization. And in this way, this will combine the following into consideration in the process of your edge documentation. The first one is that a management view must be considered with respect to the aim to which it uses information produced internally by its risk management function, whether by way of financial risk management function or by way of enterprise risk management, which you know as ERM within the organization. The second thing is that apart from considering the management view with respect to risk management, we also consider the accounting view that seeks to address risk management issues with respect to the timing of recognition of gains or losses that are attributed to those risk management exposures. The third issue there is that edge accounting principle with respect to the documentation that precedes it now should be much more of an objective-based assessment for edge effectiveness than quantitative-based. That is why IFRS 9 deviated slightly from the quantitative base of measuring edge effectiveness under IS 39. Do you get what I'm saying now? And we're going to see that as we move forward. When you consider these three, it will form a basis for your edge documentation. Now, in your edge documentation, certain conditions need to be documented to demonstrate that you met those conditions which are in tandem with the requirement of IFRS 9. And these conditions are precedent to you adopting voluntarily Hedge Accounting, which means if those conditions are not met, as may be documented and described in your Hedge Documentation, even when you have the will to voluntarily adopt that accounting, you cannot, because there's a condition precedent to its adoption. Okay, adopting Hedge Accounting provision of IFRS 9 is mandatory where hedge relationship meets all of the following criteria. Now, you must meet all of the 3 criteria that I'm going to describe. Okay, it's not meeting 1 or 2 of them. The 3 must be met for you to adopt that account. Otherwise, you need to go back to the status quo where you account for the derivative as a derivative, which impact goes to profit or loss immediately, regardless of when the impact or risk exposure of the hedge item impact your cash flow or your profit or loss. Now, the first condition here is this. You must be able to describe the hedge relationship. And the hedge relationship consists only of eligible hedge instruments and eligible hedge items. Now, what do we mean by eligible hedge instrument and eligible hedge item? First, financial derivative should primarily be the only eligible hedge instrument that you can use to hedge financial risk. But there's an allowance to use financial assets and financial liability other than derivative. But that exception only applies to hedging against exposure to foreign exchange rates. Regardless of that fact, no other instrument can be designated or described as hedge instrument for any purpose other than those mentioned. Likewise, hedge item must be 1, you are hedging on asset you control, or you are hedging on liabilities you owe by way of present obligation, or you are hedging against firm commitment, or you are hedging against forecasted cash flows that may have impact on your operation. Any other thing other than that, such cannot be described as a hedge item. That is the first condition that must be demonstrated, which means your hedge relationship, the economic relationship, the qualification of such hedge item and hedge instrument must be described in your hedge documentation as part of your hedging objective. The second thing is this. The condition speaks to if at inception it was designated as a hedge with formal documentation, including identification of the identified hedge item, hedge instruments, the nature of the risk that you want to hedge, and how entity will assess the effectiveness of the hedge instrument in trying to hedge the exposure of the hedge item with respect to variability in cash flows and in the fair value. If you're able to demonstrate this by showing the qualification, that is what you have designated as hedge item and hedge instrument, meet those qualifications as defined in your hedge documentation that describe the basis to which you have tried to hedge an item, such will be considered to have been met, which means you have met the first condition and you have met the second condition with respect to formal documentation. The last condition is this. The last condition speaks to the economic relationship that is expected to exist between the hedge item and the hedge instrument. And this is to measure how effective an hedge is, be it a perfect hedge or otherwise. Now, the hedge relationship meets all of the following conditions that deals with hedge effectiveness criteria. The first one is this. You must be able to demonstrate that there's economic relationship between the hedge item and the hedge instrument. What is an economic relationship? The economic relationship is that if an hedge item is exposed to a risk, and if the risk goes up, the hedge item suffers a loss. And if the risk comes down, the hedge item enjoys a gain. Now, the hedge instrument you must be the one that when the hedge item suffer a loss, based on that exposure, he will enjoy a gain. Whereas, or conversely, if the hedge item enjoys a gain based on that exposure movement, the hedge instrument must suffer a loss, which means that is when you can say there's an opposing economic relationship between the hedge item and the hedge instrument. That is one, under that criteria. The second one is this: the effect of credit risk does not dominate the value of the hedge instrument. What it simply means is this: though there might be element of credit risk that influences the movement in the value of the hedge instrument, be it a gain or a loss, but it must not dominate such that it forms the material components of the movements in the hedge instruments. And that is why it can be concluded and said as thus to say that the effect of credit risk does not dominate the value changes that result from the economic relationship, that is, the gain or loss from the credit risk does not frustrate the effect of the changes in the underlying value of the hedge instrument or the hedge item, even when those changes may be significant, but they must not be extremely material to the value of the hedge instrument or the hedge item or both. Lastly, is issue of quantification of hedge effectiveness, which we call the hedge ratio. The hedge ratio, which I've described here, let me share my note again. The hedge effectiveness is measured by this hedge ratio. Okay, hedge ratio is the ratio of gain of hedge instrument to loss of hedge item, or loss of hedge instrument to gain of hedge item. Okay, now the hedge ratio of the hedging relationship, that is quantity of hedging instrument versus quantity of hedge item, as I've described it in the formula I've given to you, is the same as the resulting from the quantity of the hedge item that our entity actually hedges and the quantity of hedge instrument in which the entity actually uses to hedge the quantity of the hedge item. Now, and which is what I've summarized here for you. But to further summarize it, is that risk managers decide on the amount of hedge instrument they need in order to hedge a particular risk, which is what I told you. What is the portion of your exposure you are trying to avoid or transfer? That will influence what portion, either as a component or as a part of a whole, that you decide to hedge. And that is determined by financial risk manager within the company based on the risk capacity and appetite and risk objective of an organization, as may have been defined by the board of the organization. This is known as the hedge ratio of the hedge relationship or hedging relationship, as I've described earlier. Now, one thing you need to understand is that IFRS requires that hedge ratio used for accounting based on relationship between the actual amount hedged and the actual amount of hedging instruments used to do so must be the same, which means you must be the same thing between risk management framework and the accounting framework, so that everything is in tandem, so that there's no divergent view between when certain exposure to risk with respect to gain or loss are recognized for accounting purposes and are recognized for decision-making purposes, which means two of them must go hand in hand. But take note in this concluding phrase that you cannot proceed to adopting hedge accounting under IFRS 9 without first your hedge documentation, because it's your hedge documentation that will define your hedge objective or hedging objective, will define the nature of the risk you are to hedge, will define what is your hedge item, will define what is your hedge instrument, will define what portion of your hedge item are you trying to hedge, and what will form the basis of defining your effectiveness of any hedge that has been taken at a point in time. And that's that position there. Now, the next discussion now is for us to look at what are the types of hedges that an organization is exposed to. And I'm going to introduce that by showing you that we have three types of hedge. First hedge is the fair value hedge. Second hedge is the cash flow hedge. And the third hedge is where you hedge your net investment in a foreign operation. And your foreign operation can be a foreign subsidiary. Your foreign operation can be a foreign joint venture. Your foreign operation can be a foreign branch, and equally can be a foreign associate. And we're going to see all of those things as we move on. If there's any question, please do not hesitate to ask me. And as you can see here, I've told you hedging risk components. You can hedge the entire component, and you can hedge a single component. And that is the position of IFRS 9. But under IAS 39, you must hedge all of the risk component. But in this case, you can hedge a component part of the risk, not all the entire risk, because what you might do is that you want to assume some level of risk, and while you hedge the other component of risk. And that is the beauty of risk management in an organization. Now, I want somebody to read this as a summary condition for hedge accounting, which I've explained earlier. Who will read this, and let us move further?
Okay.
Over to you, Sheldon.
Sorry. The hedging relationship consists only of eligible hedging instruments and eligible hedge items. There must be formal documentation, including identification of the hedged item, the hedging instrument, the nature of the risk that is to be hedged, and how the entity will assess.
Can you hear you again?
Okay. There must be formal documentation, including identification of the hedged item, the hedging instrument, the nature of the risk that is to be hedged, how the entity will assess the hedging instrument's effectiveness in offsetting the exposure to changes in the hedged item's fair value or cash flows attributed to the hedged risk. C, the hedging relationship meets all the following hedge effectiveness criteria. 1, there is an economic relationship. 2, the effect of credit risk does not dominate the value. And 3, the hedge ratio of the hedging relationship.
Okay, thank you for that. Now, I've told you we have, later on I'll come to discuss the continuation of hedge, but I want to take you to the part of all of this. I've discussed them. I want to take you to the part of quantifying hedging relationship, which will lead us to understanding that there are three types of hedge. Fair value hedge. When you get fair value, remember we talk about market price in one point or the other, or at one point or the other. When you have a fair value hedge, what you are simply hedging is the changes of movement in the price of an underlying asset or variable, such as price of commodity going up or coming down. Do you understand? Exchange rate going up or what? Coming down. These are prices, market prices, moving up or down. Whenever you are exposed to movement in market variables such as price, exchange rates. Therefore, and you believe that that will impact your value at which you buy or you sell or you realize an item. Therefore, you are exposed to fair value changes. And in that situation, the appropriate hedge you can take by way of forward contract or futures contract is to hedge that price movement or volatility. And that's so called a fair value hedge. And IFRS 9 defines a fair value hedge as a hedge of the exposure of the changes in the fair value of a recognized asset or liability or identified portion of such an asset or liability that is attributable to a particular risk and could affect profit or loss. How does that differ from cash flow hedge? The word cash flow means you are not hedging volatilities in prices. Rather, you are hedging variability in cash flows. That is fluctuation in your cash flow. Your cash flow is not balancing because your cash flow, though in the foreign currency, is the same thing with what you expected. But when you bring it to your local currency where you'll be spending it, the value is changing, which means it's moving up and down, which distorts the way in which you plan your spending or your investment. And in that situation, you're exposed to cash flow variability. And in that case, you enter into what we call a cash flow hedge. Commonly, cash flow hedge is when you hedge foreign exposures, because that is what brings more about variability in cash flow. Where you earn naira, but you spend in dollar, or you earn dollar, you spend in naira. Do you get it now? That's when you are exposed to cash flow hedge. And the standard defined cash flow hedge as a hedge of the exposure to variability in cash flow that is attributable to a particular associated with a recognized asset or liability, such as all or some future interest payment on variable interest rates or highly probable forecast transactions such as anticipated purchase or sales, and that could affect your profit or loss. And this also speaks to your loans. If you borrow loan at variable interest rates, you also have cash flow variability, because if the market interest rate goes up, you'll be paying more. If it comes down, you'll be paying what? Less. That also triggers much of exposure to cash flow variability. Now, there's something I've told you I'll get back to, and that speaks to when you want to hedge your exposure to the net investment in a foreign operation. What are you saying? If we have a subsidiary, let me give you a practical example. We've done group account to some extent. When you have a foreign subsidiary, let's say our foreign subsidiary is in Ghana. You set it up with $1 million. You took $1 million from Nigeria to Ghana to set the company up. That was 5 years ago. And as of 5 years ago, okay, let me use Ghana cedi, since I'm using Ghana. 5 years ago, as of 5 years ago, Ghana cedi is 10 Ghana cedis to one, what's it called? 1 naira. No, sorry, 10 naira to 1 Ghana cedi, I mean. And you invested 1 million Ghana cedi, which means from our money, we took out 10 million Ghana cedis, because 1 Ghana cedi is 10 naira. Now, 5 years ago, you took 10 million naira of your cash flow to invest in Ghana. And equivalent amount of that in Ghana 5 years ago was $1 million. Let us now assume that that investment today, if you are to dispose it in Ghana, assuming there was no interest or there was no dividend or return we have got over 5 years, but the value of that investment today is worth 1.2 million Ghana cedis. Now, have you made gain or not in Ghana cedis? I want an answer.
In Ghana cedis, there's gain. Yeah, you had made gains in Ghana cedis.
Now, but today, you have made gain of 200,000 Ghana cedis. Is that not?
Yes.
You'll be happy. But unfortunately, today, Ghana cedi is 6 naira. Now, let us bring back our $1.2 million back to Nigeria. I want 1.2 million Ghana cedi back to Nigeria. How much is it? 1.2 million that you thought you have made as gain in Nigerian naira today. How much is it worth? It's worth 7.2 million naira. In Nigerian naira now, have you made a loss on that investment or a gain?
You made a loss.
Yeah, and that's what we are talking about. Therefore, if you want to avoid this, what do you believe you can do? Other than writing a derivative contract to exchange the dollar or to exchange the Ghana cedi to naira, what other hedge instrument can you create to do this? Let us think it out. What hedge instrument are you going to take to do this?
Use foreign exchange hedging.
Without using derivative contracts. You know, I told you that derivative contract is the fundamental for hedging risk. But I said for risk of foreign currency rates, you can also use non-derivative contract, which can be financial asset or financial liability. Give me a practical example. Think it out as a risk manager now, not as an accountant. What kind of instrument can you use to hedge it other than derivative? This kind of scenario. Who answer me? Am I waiting? Okay, let me give you a clue.
If I can just, the gain I've made on that Ghana cedis, what if I invest it in maybe their government bond or government securities?
The gain you made, in which year? As at the point of sale.
Yes.
How does that solve your problem? The gain of 200,000 Ghana cedi, how does that solve your problem of the loss in naira?
Okay, that means if I'd gone into like an hedging contracts before the time of disposal of that.
And what hedge contract will you enter into?
Yeah, that would be foreign currency hedging.
And what contract will you use to hedge your foreign currency in that scenario?
The forward contracts.
I said without using derivative. You forgot it.
Contract again. I don't know.
Okay, what stops you from taking loan at the same time so that you pledge your subsidiary in Ghana as a collateral for the loan you took in Ghana, and immediately you brought back the money into Nigeria? As at the time you took 10 million naira to Ghana to buy a company in Ghana for 1 million Ghana cedis, you also take, if you want to fully hedge your risk, you also take a loan from Ghana worth $1 million, and you use that subsidiary as a collateral. And immediately you took that $1 million in Ghana, what do? You bring that money back to Nigeria at 10 naira, which is 10 million, and start to use it to do business in Nigeria. As at the time you now dispose of the subsidiary in Ghana, you take that money to settle the loan, tit for tat, in the same currency. You sold it in Ghana for $1.2 million. You settle back your loan of $1 million, having paid interest over time, and you bring back the $200,000 at that lower value. Has that not solved your problem?
It had. But it's still similar to buying the government bond too.
No, where do you get money to buy government bond? Where you have even invested in Ghana cedi, where do you not get money to buy government bond? Where are you getting the money? Which one?
Yeah, that is true. I understand now. I understand.
Okay, that is that. That's why you find out that some people take loan, even though they don't need it, but they need it as an instrument to hedge something. Are you getting it, sir?
Yes, sir.
Yeah. Okay, that is that. Now, hedge of a net investment in a foreign operation is a hedge of the amount of the reporting entity's interest in the net asset of such an operation. Okay, now, what is the accounting implication of this? I'll share it one by one. Okay, when it comes to a fair value hedge, once you adopt voluntary accounting, whether the standard that governs that hedge item requires that item to be measured at fair value or not, compulsorily you measure that item at fair value, profit or loss. I'll give you an example. If what you have hedged is inventory that you have in stock, and IS2 says inventory should be carried at what? At cost, or where the realizable value, net realizable value is lower than the cost, you carry it at net realizable value. That is what IS2 says. But if that inventory is something that I've entered into a fair value hedge on, I will jettison the requirement of IS2. Why? Because the hedge instrument will be measured at fair value, which is the derivative. The hedge item also will have to be measured at fair value, so that the fair value impact of the hedge instrument and the hedge item will both meet in profit or loss, in order to take away the volatility we are talking about. Can you remember what I told you the purpose of hedge accounting?
Yeah.
And I'm going to show you an example of that. But there's an exception to the rule. The exception is for financial assets that is measured at fair value to other comprehensive income, usually equity instrument for that matter. When you have shares, investment in shares of companies that qualify as fair value to other comprehensive income, remember they are to be measured at fair value, but their fair value changes go to OCI, other comprehensive income. That means that the gain or loss from the hedge instrument also, instead of going to profit or loss to cost mismatch, will go to other comprehensive income, which is an exception to the rule of taking gain or loss on derivative to other comprehensive income, because naturally they're supposed to go to profit or loss. The essence of doing that is also to avoid accounting loss mismatch. Okay, thirdly, if hedge item is a debt instrument that is measured at amortized cost or is measured at fair value to other comprehensive income, any hedge adjustment is amortized to profit or loss based on the recalculated effective interest rate, which means, remember that for debt instrument, you still measure it based on effective interest rate to account for your interest cost. It then means that the gain or loss from the hedge item must also be amortized the same way you are amortizing your interest component, so that there's no mismatch at the end of the day over the life of that asset. And take note, amortization may begin as soon as the adjustment exists and shall begin not later than when the hedge item ceases to be adjusted for in the hedge in determining the gain or loss from the hedge instruments. Okay, but let me start with, before I move to cash flow hedge, let me show you an example. Let me get you an example, and let me get you an example, and we'll go back to our writing material. fair value hedge. This question is on fair value hedge. Okay, I believe you guys can see it clearly. If not, let me enlarge it. Okay, I want somebody to read this question. Who will read the question?
Let me read. Fair value hedge. A company owns inventories of 20,000 gallons of oil, which costs $400,000 on 1st December 2023. In order to hedge the fluctuation in the market value of the oil, the company signs a future contract to deliver 20,000 gallons of oil on 31st March 20x4 at the future price of $22 per gallon. The market price of oil on 31st December 20x3 is $23 per gallon, and the future price for delivery on 31st March 24x is $24 per gallon. Required. Explain the impact of the transactions on the financial statements of the company. A, without hedge accounting. B, with hedge accounting.
Now let's start. Without hedge accounting, the implication is this. One, inventory. What's the inventory now? 20,000 gallons of oil will be accounted for at cost. What is the cost again? The cost is $400,000 in accordance with IS2 and will not be subjected to changes in the market prices, except where the market price less cost to sell. Remember, the market price here is fair value. Cost to sell is below the cost. Is that not what IS2 says? Now, this is because we are not doing voluntary accounting. Two, the hedge instrument here, which is a futures contract, will have to be measured at fair what? Value at every reporting date up to the settlement what? Date. Therefore, in this case, what is our reporting date? Our reporting date is the date next to this date, and which is 31st of March, 20x4. And as at 31st of March, 20x4, as at 31st of March, 20x4, the market price is now 23 per gallon, but the actual future price, the future price is 24, which means, you know, future price is what we're to deal with under hedge instruments. This market price that is 23 and 22, they have no effect on our inventory valuation. But now, what is my gain or loss from fair value of the instrument? Now, look at what we have done. We have entered into a contract in order to hedge the fluctuation in the market price of oil. The company signed a future contract to deliver 20 gallons for how much? 22. But eventually, as at the reporting date, other people are now delivering for future price at what? 24. Which means if we knew that it's going to be 24, we'll have done 24, which means we have lost 2. Therefore, what do? We need to recognize loss on futures contracts. The loss on future contract is the difference between 24, which is a new price in the market for future delivery, and 22 that we have already entered into. This is 2 per gallon. How many gallons have we committed to in the future to deliver? Our future contract we signed is committed to deliver 20,000 gallons, which means the fair value loss in this case is on the futures contract is $2 times 20,000 gallons. And that is $40,000. And what do we do in this regard? You debit your profit or loss, which we call loss on derivative contract, and you credit your financial liability awaiting settlement with this $40,000. This is a pure accounting you have done. And this accounting is what is required you to do with respect to measuring derivative at fair value to profit or loss, if you remember the category. Okay, but this will not be what we'll have done if we have adopted Hedge Accounting. Where we have adopted Hedge Accounting, what will be the implication? B, with the adoption of Hedge Accounting, what will have been our position? Where it will be significant for changing our position is that what we took care as our position will no longer apply, which means the rule of IS2 will no longer apply here. Or because to avoid mismatches, we need to fair value our inventory with respect to the market price. And therefore, what do we do? IS2 requirements to measure inventory at cost or at net realizable value, where the latter is lower, we no longer apply. Hence, the inventory being the hedge item will have to be measured at fair value at every reporting date up to when it has been sold. Now, how do you do that? This expression I've made, how do we demonstrate it? The demonstration will be as follows. Inventory measured at fair value at the reporting date, March 20X4. What is the fair value? The fair value is the current price. What is the current price? The current price as at that reporting date is $23. So my reporting date is 2003, not 2004. $23. Times 20,000 gallons. Compare with the cost or carrying amount, which is 400. And that 400 is simply $20 if you work back times 20,000 gallons. Now, 23 times this is 460, which means there's a gain on inventory, which means the inventory you carry your books at 400,000 is now worth 460, which pays you. But you have already entered into a derivative contract which took money away from you of 40,000, which means net. Let me copy and I'll clean this off. I don't want to rewrite it. Sorry. Yes. Okay. That means the only difference between is for you to this is our one. It's for you to value the inventory at fair value as opposed to not valuing it at fair value. And once you have done that, the impact invariably, this is the same thing as saying difference between 23 and 20, which is 3 times 20,000 gallons. That is it. Now, the net impact in your profits, the net impact in profit or loss for the year ended 31st March 20x3 is as follows. The gain on fair value of inventory is 60. The loss on fair value of futures contracts is 40. Net, what is your gain? Net gain on hedging is $20,000. That is the impact on your profitability, which has reduced the volatility at the end of the day. Any question on this?
Excuse me, sir, is it this net gain that will be recognized in the P&L?
No, the net gain is what is recognized in your P&L. Because the same account that 60 is going to is where 40 is going to. They are offsetting. The net impact of your hedge is 20. That's what it means.
Okay.
Now, let me give you, with your knowledge of this, let me take you back there. I'm going to give you a question which I'll give you 5 minutes to attempt. After attempting it, I will also try to attempt mine and we'll compare solutions. This is another question. Shegun, I want you to read the question before you guys proceed on 5 minutes to, I think I want you to discuss it together, but read the question first before I allow you to go into your session to discuss it together.
Okay. Please, can you help me enlarge it a little?
It's because I want you to see.
Okay.
The
Okay.
solution. Right.
Okay.
Okay, but let me enlarge it before, so that you read it first, I'll bring it back to the position.
Okay. On 1st July 20x6, Jews acquired 10,000 ounces of a material which is held in its inventory. This cost 200 naira per ounce, so a total of $2 million. Jules was concerned that the price of this inventory would fall, so on 1st July 20x6, he sold 10,000 ounces in the future market for $210 per ounce for delivery on 30th June 20x7. On 1st July 20x6, the conditions for hedge accounting were all met. At 31st December 20x6, the end of June's reporting period, the fair value of the inventory was $220 per ounce, why the futures price for 30 June 20x7 delivery was $227 per ounce. On 30th June 20x7, the trader sold the inventory and closed out the futures position at the then spot price of $230 per ounce. The IFRS 9 hedge accounting criteria have been met, required. Set out the accounting entries in respect of the above transactions.
Okay, thank you very much. Okay, you have 5 minutes to start your discussion. Shegun, you lead your team in this discussion.
Okay. So we can start now, right?
Yes.
Yeah, it's all right. I have Enauro, Nirudin, Mrs. Grace, and
Okay, thank you. We are back to it now since you guys have had some deliberations on it. I think the first step is to do this. I want to profile the solution. Suggested solutions. Now, let me first of all create a table. Okay, I want to create a table between the spot price. Sorry. Spot prices and forward prices. Now, the first day is the trade date. We enter into this trade on 1st of January, 1st of July. Okay. We purchase the inventory 1st of July. And we also enter into the contract 1st of July, which means our trade date, the spot price is $200, while the future price is 210. And this 210 is for future delivery. It's deliverable on 30th of June 20X7. Our trade date is 1st of July 20X6. Our first reporting date, anytime can be a reporting date, can be monthly, quarterly, yearly at least. Our first reporting date is 31st December X6. The fair value of the inventory has now gotten to 220, which has moved by $20. And the future price for the same delivery has moved to 227. It's still the same delivery date, but has moved to 227. Why I'm putting this date is because they are forward prices. They are not meant for transaction on this date, but for future delivery on this date. Finally, on 30th June, the trader sold, that is settlement date. Was 30th of June. Let me write it the same way I've written others. X7. They eventually sold the inventory for 230. And they didn't give us information about futures. Futures and spot will converge on the same date. That is one of those things you need to learn. Note, let me note it for you. In derivative contracts, technical note, future and spot prices will always converge at settlement date. That is a simple principle you need to know. Future and spot prices will always converge at settlement dates. The same way future value and present value will always converge at the last date, where the effect of time value of money will no longer be relevant. That's just similar analogy. Now, when you have this table will always help you at every point in time. Now, what then do you do? To fast track what we need to do, I'll just give you the answer and I'll explain it. Now, for the first reporting date, which is this date I've mentioned here, these aspects, this will be derivative, which is the hedge instrument. And these aspects, this will be the hedge item, which is the inventory itself. Now, let me start with the hedge item. The inventory, as at when it was purchased, was $200. But now the inventory, if you are to sell it today, is $220, which means it's better for you. And you have made $20. And this is the $20 here. Difference between $220 and $200 will give you $20. This $20 is what you multiply to the 10,000 ounce, which make up this 200, which speaks to what my brother Nuruddin said. You made 200, your inventory value will be increased by 200 and your profit or loss will be increased by 200. You've done this fair value because of the fair value voluntary hedge accounting you have adopted. Therefore, you now need to also fair value the derivative. You enter derivatives to deliver at 210, unknown to you that in few months' time, people will be demanding for higher delivery rates, which means if you are aware, you'll have not agreed at 210, but you have already locked in at 210, which means invariably you have lost 7 naira. And this is the 7 naira here. The 7 naira or $7 multiplied by 10, it's what give you the 170,000 loss. As you are gaining on one side, you are losing on the other side. And because it's a derivative, the loss of a derivative is a creation of liability. And that is that. Effectively, if I can copy what is here and put it here, let me reduce the margin so I can. How to effectively, if I come to this date, effectively, as at 31st December 20x6, the gain here of 200,000 is offset by the loss of 170. And the net effect on your profit or loss is what? 30. Any question on this before I look at the settlement date? Any question on this? Any question? If there's no question, at settlement date, what has happened? Sorry, my stuff did not save. Okay, it's back on. Okay, now the other periods. How do you arrive at the other periods? Remember from here, we are now at settlement date. The inventory has moved from 220.
Sorry, I can't see anything here.
The whiteboard is not showing properly.
Okay, sorry. Can you see it now?
Yes.
Yes.
Okay. Now it has moved from 220 between 31st December 2086 to 230, which was the date it was sold, which means eventually the market price has moved by $10 in the space of 7 or 6 months. And that is what you find here. $230 minus 220 will give you $10. Multiply by that 10,000 ounce. And that is this, which means there's another gain you have in your fair value. But there's a loss corresponding to that because this has moved from 227 to 230 again, which means you have lost additional $3. And that $3 loss multiplied by 10,000 ounce will give you this. Now that is that. Now, when you sold the asset, you sold at 230. That means you have to move the inventory. Remember, the inventory value at point of sale is as thus. The initial cost, which was 1st of July, 20x6, initial cost, which was, what was our initial cost? Initial cost was 2 million. 2 million because of $200 times 10,000. On the 31st of December 20x6, there was fair value gain of 200,000. If you remember the gain here, 200,000. And there's another gain here on 30th June 20x7 of 100,000, which means the inventory value has been restricted to 2.3 million. Upon selling that inventory, you have to move 2.3 million from your inventory cost to your cost of sales, which is what you have here, cost of sales. That is 2.3 to take the inventory out because it has now been sold. Now your revenue is also equal to cost of sales because you sold it for 2.3. And that is what you have here. $230 times 10,000 ounce. You have that. And you receive cash. Invariably, what you have done is that in your trading account, your revenue will approximately match your cost of sales by 2.3, which means there was no gross profit. Why? Because you have taken this away from trading activity to hedging activity. Gross profit is nil. Now, when you come to your profit or loss, you have now brought it into what we've done here. Let me just bring it back. Your profit or loss impact will now be as at 30th June 20x7. What is the fair value of the inventory? 100. And what is the fair value loss of future contract? 30. That's 70. Which means what will have come into your cost of, into your gross profits, all of them have gone into your profit or loss directly by way of hedging arrangements. Which means invariably, your entire cost of goods sold, sorry, not cost of gross profit, sorry, I mean cost of goods sold. The entire cost of goods sold or cost of sales should have been reduced below 2.3 million, if not for hedge accounting. But all your profit that's supposed to have been reported within gross profit have been reported, one in 2016, which was by way of 30,000, and one in 2017, which was by way of 70,000. And that is what we have done. Now for the cash, because now the derivative has reached the settlement date, you then need, this is the at settlement date. Settlement date being 30th of June, 20x7. You now need to pay out the person you have entered into derivative contract with. Remember, you enter into derivative contract to sell at what? At 210. But eventually, the market, as at that date for futures, is delivered at 230. The difference between 230 and 210 is $20. $20 times 10,000 ons account for all what you have more or less spread over 2 periods. That is 200,000. Remember, the first spread was 170. The second one was 30. 30 plus 170 make up the settlement. That is settlement amount on forward contracts. Is as follows. You have to deliver at 210, but the market is going for what? 230. You pay the differential of negative what? $20 for 10,000 what? Ons. And that will give what? 200,000, which is broken down as thus, or analyzed as thus. Fair value loss as at 31st December 20x6, which was 170. Remember this 170. This 170. And another 30 as at 30th June. That's how we have this 200, which was settled in cash by crediting your cash and extinguishing your liability. Does that make sense now? Does that make sense now?
Yes.
Okay. Any other question before we look at the cash flow edge? Okay, let's look at the cash flow edge, the account implication of cash flow edge. Now, listen carefully to cash flow edge. The principles slightly differ. For cash flow edge, we need to always identify the effective portion and the ineffective portion. Why? Effective portion will be warehoused in other comprehensive income. Why ineffective portion will be immediately recognized in profit or loss. And lastly, the effective portion will be released at the point of when the actual cash flow impact affects either the profit or loss or the underlying edge item in terms of capitalization of asset or liabilities, where such amount so aggregated as cash flow edge reserve will be used to reduce or to increase the amount so recognized for the edge item at settlement. And I'm going to explain that practically. with illustration. Luckily, we have discussed what is effective portion and what is ineffective, looking at the hedge effectiveness. And as I said earlier, we are going to recognize effective portion up to 100% of the movements by way of gain or loss in the hedge item. Anything beyond that will be considered ineffective. And anything significantly below that will equally be considered what? Ineffective. Now, I want somebody to read this summary before I present you with the practice question to demonstrate that understanding.
Okay. Accounting for qualifying hedging relationships. There are three types of hedging relationships. Cash flow hedge. For a cash flow hedge, the cash flow hedge reserve in equity is adjusted to the lower of the following in absolute amounts. 1, the cumulative gain or loss on the hedging instrument from inception of the hedge. And 2, the cumulative change in fair value of the hedge item from inception of the hedge. The portion of the gain or loss on the hedging instrument that is determined to be an effective hedge is recognized in OCI, and any remaining gain or loss is hedge ineffectiveness that is recognized in profit or loss.
Okay. Thank you. I'll also switch to this, and I want you to read this again in addition to what you have read. Can you read this?
Okay, cash flow hedges. The hedge, the risk of change in value of future cash flows from your recognized assets or liability, or highly probable forecast transaction that could affect profit or loss, e.g., hedging a variable rate interest income stream. The hedging instrument is accounted for as follows. A, the portion of the gain or loss on the hedging instrument that is effective, i.e., up to the value of the loss or gain on cash flow hedge, is recognized in other comprehensive income. Items that may be reclassified subsequently to profit or loss, and the cash flow hedge reserve. B, any excess is recognized immediately in profit or loss. The amount that has been accumulated in the cash flow hedge reserve is then accounted for as follows. Hey, if a hedge forecast transaction subsequently results in the recognition of a non-financial asset or non-financial liability, the amount shall be removed from the cash flow reserve and be included directly in the initial cost or carrying amount of the assets or liability. B, for all other cash flow hedges, the amount shall be reclassified from other comprehensive income to profit or loss in the same period that the hedge expected future cash flow affects profit or loss.
Thank you. Therefore, let's look at this illustration. Can you read this illustration? And I want somebody to interpret what you have read and why is it a cash flow hedge before we attempt solving it.
Betco signs a contract on 1st November 20x1 to purchase an asset on 1st November 20x2 for 60 million pounds. Bet reports in US dollars and hedges this transaction by entering into a forward contract to buy 60 million pounds on 1 November 20x2 at US dollars $1 to 1.5 pounds. Spot forward contract for delivery on 1st November to X2. On 1st November X1, the spot rate is US $1 to 1.45 pounds. US $1 to 1.5 pounds. On 31st December X1, spot $1 to 1.2 pounds for contract, $1 to 1.24 pounds. On 1st November 20x2, $1 to 1 pounds, and contract $1 to actual 1 pounds. The IFRS 9 hedge accounting criteria have been met. Require show the double entry relating to this transaction at November 20x1, 31st December 20x1, and 1st November 20x2.
Okay, who can assist us to interpret this question? In layman's business language. In layman's business language.
Okay, I think I can try. Yeah, the company Betco has a functional currency, which is the US dollars, but have now entered into a contract to perform a particular service at an amount denominated in euro, which is 60 million euros. So it means the company reports in dollars, but has to execute that contract in euros. So automatically, it creates a cash flow edge, because apart from the contract to deliver a service or to deliver a good, whatever, there's another underlying contract that results from the differences in functional currency and the currency in which the task will be performed. So we can also see that because of that, it had creates a kind of edge accounting situation, because the amount at which the amounts, if you read Bet report in US dollar and edge the transaction by entering into a forward contract to buy 60 million euros on 1st November 2002. So at the time it was entering into the forward contract, the rate was $1 for 1.5 euros. And as at the reporting period, show the double entry of transaction as 1st November 2001 and 31st December 2001. So we can see now from the table given, we can see the spot rates as a different reporting period and at the time the contract was delivered. So between the dollar and the euro. So that's just my interpretation of it.
Okay, who else can give further interpretation or contrary view? Who else? Okay, if not, the interpretation is very simple. You have intention, not even intention, you have entered into a firm commitment to purchase an item, let us say plane. You enter it on November 1st, 2011, and you intend buying it for 60 million euro. on 1st of November 2012, which means a year after. Now, you as a company, your functional currency, reporting currency is dollar because you are a US company. And because you know that there might be movement in exchange rate, which will not favor you, especially where your currency is now depreciated against the foreign currency. You'll be looking for more of your currency to buy the same amount of foreign currency. Therefore, you enter into a hedge by way of forward contracts to buy 60 million euros in a year's time at 1.5 euro for $1. But currently, which is the spot price of euro as at that date, 1st of November 2011, $1 can buy 1.45 euro. But you have planned that in 1 year's time, you want to use one of your dollar to buy 1.5, which means to buy more of euro. Now, we are now provided with the spot and forward exchange rates. The spot price at 4th of November 2011 was $1 to 1.45 euro, whereas the forward price to which you have entered to deliver on 1st of November 2012 is $1 to 1.5 euro. A month has passed or two, so that we are now at 31st of December 2011. The spot price shows that euro has started to wax stronger, which means your fears are started to crystallize and has waxed stronger so that dollar has started to fall in value as euros strengthens in value. $1 is now equal to 1.2 euro in the spot market, where you can buy today and collect it today. But in the forward market, where you can enter into today to buy, but get it in the future, it has also dropped to 1.24 euro to $1. And in a year's time, which we are looking up to, the actual price was such that dollar has fallen significantly, so that it's now at par with euro at 1 to 1. 1 euro is equivalent of $1. And your forward price will also be the actual. Remember, I told you that the two rates will converge. Forward and spot will converge as settlement. And that is what the word actual here means. For those that understand the derivative operation and its market. Which means sometimes examiner might decide not to give you this. An examiner, if I'm the examiner, I'll just put question what? Mark. Which means to be determined by you. And if you understand the metrics, at every settlement, there's convergence of rates. The spot and the futures or forward will convert to the same value at settlement. That is that. Now, that is the interpretation of the question. The question then is, we have 3 spot or 3 periods which are of concern. The first one is the trade date. The second one is the first reporting date, if we have other reporting dates. And the last one here is the settlement what? Dates. The question then is, what are the accounting at each of these dates? Trade date is the same thing as initial date or initiation date, reporting date, and settlement date. Trade date or initial date is the date you enter into the contract where you became a party to the forward contract, which has now been used as hedge instrument. Reporting date and settlement date is the date of delivery, where all parties will have to settle and move on. Now, let's start with the trade date. What is my proposition? As at the initial recognition, which is the trade or initiation date, the value of a forward contract at inception is always 0. No accounting entry, because both parties that is willing to buy and willing to sell have only signed a contractual document. The only time there might be 1 or 2 value is a very little value, insignificant to the fact that you might have transaction costs. And such transaction costs will have been accounted for in your profit or loss as expense. And you have to disclose that along with risk disclosure, which we are going to discuss under IFRS 7, which means there's no transaction. Now, because you have a firm commitment, you have what we call a firm commitment to buy an asset, in this case, probably an aircraft. Let me write it clearly for record purposes. You must disclose that if it is material in line with the requirement of IAS 60. That is the first thing we need to do, which means there's no accounting as of the trade dates, except where there might be transaction costs, which in this case, there's none. Now, the second accounting is at the reporting date, 31st December 2011. And what has been the accounting? As at that date, the position of my accounting will be as follows. Now, you know, there are 2 sides to the story. The forward contracts and the firm commitments. But this is not a fair value hedge. We are not going to fair value the hedge item, no, because the hedge item has not had cash flow impact yet. Because cash flow hedge is cash flow, not price movement. Therefore, what we only fair value is the derivative contract, which is this forward contract. Now you enter into a forward contract, if you remember, at 1.5, but now it is 1.24. Now what it means is that from the spot angle, you will be paying more to buy the assets, which means you are losing from the firm commitment side if you are to buy the asset on these dates, 31st December 2011, because you will need how much dollars to buy 60 million euro jets? How much dollar will you need if you are to execute your trade on the spot on 31st December 2011? You will need 60 million euro divided by 1.2 euro. That means you need 50,000. Whereas before, what you needed at 145, at 1.45 was 41, which means you are losing at the spot side. Automatically, you'll be gaining at the forward price, because at this point, you have committed to buy at this rate. Therefore, what then it means is that the movement between 1.5 you will buy and 1.24 that it's now going on for is the gain you have received from the forward contracts. Because if you buy at 1.5, which you have locked it in, you get 40,000. But the market is now going for what? 48, which means you will be paying $40,000 cheaper for you than what the market is now going for at 48. And this is how you determine that. Remember, this is still the euro price. euro price, which means in these 4 contracts, you have gained $8.3 million. But when you compare it with the movement in the assets, even though it's unrecognized because this is a cash flow hedge, it's not fair value hedge where you have to recognize it and show movement in the fair value of the hedge item. You find out that before now, if you have bought the jet, you'll have bought the jet for how much in dollars when it was the spot price, when it was spot price of this, which means at the spot. This is how much you'll have bought it for. 60 euro, 60 million divided by 1.45. You'll have bought it for 41 point something euro. That is, you'll have bought it for 41,379, $310. But today, if you have to buy today, which is the reporting date, you are now buying at 120 euro per dollar. Are you buying more or less? 60 euro, 60 million euro divided by 1.2. You are buying more for 50 million euros. Which means at the end of the day, if you are to buy at today's price, you are losing and you'll have lost the difference between 50 and 41. That means you'll have lost this amount. 50 minus this is this amount. At the end of the day, the gain you made here is offset by the loss here. Now, but because if you look at this is a significant portion of this, which means at least, even though you are unable to recover 100% of the loss, but when you look at the ratio, which is the hedge ratio in this case, which is the gain on the hedge instrument, and you compare it with the what? With the loss on the hedge item. What do we have? 8387.096 as a ratio of 8620,690. It's a significant amount that deplete the hedge effectiveness. That's about 97.3%, which means it's highly effective. And the entire portion will be considered fully what? Effective. And that portion will go to other comprehensive what? Income, OCI. I remember your item in OCI is what comes to what? Your equity component, cash flow hedge reserve. And that is what it means. This is at the first reporting what? Date. Any question on this? Any question on this? Any question on this? Now, let us now look at the settlement dates. At the settlement date, what has happened? Reporting date, and this is what? Settlement date. Now, let's check. At the settlement date, it has moved from 1.2 to 1.0, which means dollar has fallen further. Likewise, in the futures what markets. At the end of the day, what has happened? At the settlement date, you find out that you will be buying the assets at $60,000. Why? Because when you divide the 60,000 euro by €1 to a dollar, it gives you $60 million. But before now, based on the valuation you have done in December 2011, you find out that it was $50 million because we have moved up to from 1.45 to 120. Now we are now moving from 120, which is that $50,000. We are moving to 60,000, which means you have lost $10 million, which means it paid you to have purchased in December than now. That's what it means. But you are not concerned a lot because you have hedged your risk. Hedged in the sense that the loss you have made here, you are gaining it here because as at the point of settlement, future rate is now going for 1.1, whereas you have locked in to get higher value at 1.5 instead of at 1. Therefore, and you have already recognized movements or gain between 1.5 and 1.2, but now it's now left between 1.24 and 1.0, which means here you also have a gain. The gain is that if you have gone by way of doing it now at that rate, it is $60 million. But already you have locked in your rate before now, and at this point, at 124, what do you have at 124 before? At 124 is what we have 48,387,096. I'll come here. At 124 is 48,387,096. And that is what you have gotten here. The difference between them is the gain you have made further on that contract, which augments your loss of 10 million. When you now look at it, this gain is far more than 100% of the loss. It then means your effective portion should not be more than 100% of the loss here, which means 100% of the loss is the effective portion, which goes to your other comprehensive income. This is your what? Effective portion, which goes to where? Other comprehensive what? Income. Why the balance is the ineffective portion. Effective portion goes to OCI. Ineffective portion, which is the difference after considering the 100%, goes to profit or loss. And the entire value goes to your financial asset, because a gain results in recognition of financial assets or derivative. Now, finally, upon you purchasing, you're actually going to purchase at $60 million because that's what you buy for. In the market, you buy for 60 million euro, but you have to change your dollar to get you at 1-to-1. And therefore, you also need the equivalent of $60 million. But these $60 million effectively will be reduced by your gain from forward contracts. Remember, what are your gain from forward contract? You add this first gain, and you add this second gain. Now, let me analyze it. The gains, cumulative, from the forward contract is as follows. The one you add as at the first reporting date was 8,387,096 plus the one you add as at the settlement 11,612,904. Everything sum up to $20 million. And this $20 million cumulative gain is equal to the fact that you enter into the contract when it is 1.5, and the contract was exited at 1.0, which means the difference between 1.5 and 1.0 is 0. Times the 60 million euro. Let me put it like this. Remember, a 60 million euro times what you have made between 1.5 and 1.0 of 1. And that's what you do. At the end of the day, that should give you your sum of gains. Let me press my calculator. We had 1.5 here, and you have 1.24, and later 1.24 and 1.1. Okay. Your gain. One minus the current price minus the price you have committed to 1.0, which is the forward price upon termination, which converges with the spot price and your initial forward price you enter into. Which then means that 1 divided by 1.5 will give you about 66.67%, which means the gain you have made is 1 minus that, will give you about 33.33% multiplied by the 60 million euro, which will give you $20 million. And that is how you arrive at the $20 million gain that we have analyzed. This is an alternative way of getting it also. Okay? And at the end of the day, upon settlement, you have to pay cash, or you receive cash in this case because you are the one that made gain from the forward contract. Your counterparty will deliver the forward, which is net settled in cash based on our description of the quality of that. And that is our position. Now, finally, what you eventually do is that your cash flow reserve will have to be moved from your equity portion to reduce the cost of that asset. And this is what you do to end it up. Okay, which means invariably, the cost of the asset is as thus. Purchase price, which was on 1st of November, 20x to $60,000 less the cumulative gains in cash flow hedge reserve. And what is the cumulative gain in the cash flow hedge reserve? It is this 8387096, which is the first item here, and the effective portion, which is 10 million here. And therefore, what is that? That is 18387,096. Invariably, the net purchase price of the assets is $60 million minus 18387,096. That is 41,612,904. That is that.
Sorry.
That brings us to the end of that. Yeah.
For cumulative gain in cash flow hedge.
Yeah, what's the question?
We consider 10 million and the first 8.3 million, right? Let's consider the remaining 1 point something million.
Mm-hmm. Yeah, because the portion that goes to profit or loss has already hit your retained earnings. Remember, there's a portion here that goes to profit or loss, the ineffective portion.
Yes.
That is no longer part of the reserve. What went to the reserve is the effective portion, if you remember.
Okay, yes.
Yeah. Okay. Any question? Now, for you to discontinue hedge accounting, you only discontinue it if those conditions are no longer met. That is, the hedging relationship no longer exists. Okay, and you must take note of that. Okay, I want you to read these following captions before we wrap it up with the disclosure requirements.
Okay, discontinuing.
Okay, over to you.
Discontinue. Hedge accounting should be discontinued only when the hedging relationship no longer meets the criteria for hedge accounting. IFRS 9, paragraph 6.5.6. Hedge of a group of items. IFRS 9 permits the designation of a group of assets as a hedged item, provided that the following three conditions are met. A, it consists of items that are individually eligible hedged items. B, the items in the group are managed together on a group basis for risk management. And C, in the case of a cash flow hedge of a group of items whose variability in cash flows are not expected to be approximately proportional to the overall variability in cash flows of the group, so that offsetting risk position arise. One, it is a hedge of foreign currency risk. And two, the designation of that net position specifies the reporting period in which the forecast transactions are expected to affect profit or loss, as well as their nature and volume. Accounting for hedges of credit risks using credit derivatives. IFRS 9 permits certain credit exposures to be designated at fair value through profit or loss. If a credit derivative that is measured at fair value through profit or loss is used to manage the risk of all or a part of the exposure on a fair value basis, IFRS 9 paragraph 6.71. A credit exposure may be financial instruments within or outside the scope of IFRS 9. For example, loan commitments that is managed for credit risk, IFRS 9 paragraph 6.7. This designation would be permitted if both of the following apply. A, the name of the credit exposure matches the reference entity of the credit derivative. B, the seniority of the financial instrument matches that of the instrument that can be delivered in accordance with the credit derivative, IFRS 9 paragraph 6.7. If the qualifying criteria are no longer met and the instrument is not otherwise required to be measured at fair value through profit or loss, the entity must discontinue measuring the financial instruments that give rise to the credit risk at fair value through profit or loss, IFRS 9 paragraph 6.7.
Thank you very much. Now we'll wrap it up with disclosure requirement of IFRS 7. Okay. Now IFRS 7 border on disclosing relevant information, both quantitative, qualitative, and descriptive information about financial instruments. And I've broken it down based on this diagram. The diagram captures it in all. There are three sides to the coin, or three sides to the triangle in this case. The first side is that what you need to disclose first is that you must disclose the classes of financial instruments and the level of those instruments, which means what are financial instruments you have and what are the different level of disclosures that are entailed in those financial instruments. Now, the most important aspect of it is to disclose the impact, nature, impact, and some other consequences of such financial instrument in your statement of financial position, in your statement of profit or loss and other comprehensive income, and some other descriptive disclosures, which borders on accounting policies, borders on hedge accounting, where you have adopted the voluntary hedge, which you just completed, and fair value with respect to the hierarchy of fair value that you have used, and the methodology you have used in obtaining your fair value, if it's other than the quoted price. Okay, for the statement of financial position, the following things are instrumental for your disclosure. Categories of financial asset and financial liability, your financial asset and liability that are measured at fair value, profit or loss, where there are reclassifications, you disclose, where there is the recognition, you disclose, where you have collateral underlining those assets, you disclose, allowance you have made for expected credit losses in line with IFRS 9 must be disclosed. Where you have a situation of compound instrument with multiple embedded derivatives, you must describe the instrument, disclose the implication, and how you have measured them, and how you have disaggregated them, okay? And finally, there you disclose where there are any default or breaches, whether from your financial asset side or from your own financial liability side. Now, the impact in profit or loss is such that you disclose items of income, expense, gain, and losses attributable to financial instruments. You disclose interest income, interest expense that accrue from your financial assets and liabilities. You also disclose the amount of impairment loss that has been recognized per class of your financial asset, which means the movement in your expected credit loss for the period. Other disclosures, as I've said earlier, what are your accounting policy options? Where you have options, how have you come about the options, and how consistent have you made use of the options? Hedge accounting, where you have voluntarily adopted hedge. What is the rationale for your hedge? What are your hedge effectiveness, your hedge objective, and some other things. And fair value also is critical. The final aspect of it is the nature and extent of risk arising from financial instruments. And this borders on the qualitative and quantitative disclosure regarding market risk factors that constitute financial risk. You know, your financial risk borders on your liquidity, credit, and market risk, okay? All your disclosure here will be qualitative and quantitative. Qualitative is to describe the nature of credit risk you are exposed to, how you try to mitigate it by way of policies, process, procedures, okay? Similar for liquidity risk and similar for market risk. But what is also paramount is that in line with your risk management framework, which are based on your internal models, you also quantify your risk using various risk metrics, such as VAR, value at risk, where you can determine VAR for your credit risk, for your market risk factor, and some other things, such as other risk management metrics like variance analysis, standard deviation measures, and some other measures in terms of stress testing and scenario analysis, which you can use to quantify your exposure, your appetite and capacity for risk at every point in time. What is your loss arising from certain exposures to certain risk factors? And all of this borders on the three key identified elements of financial risk: the credit risk, which is the risk of default, okay? The liquidity risk, which is the risk such that you suffer material reduction in the value of assets upon its realization. And market risk is much more fundamental, which is the risk of variability, volatility in market factors or market underlying, such as interest rates, such as foreign exchange rates, such as inflation and some other things like that. And all in all, I think this has more or less taken us a lot of time to demystify our understanding as it relates to financial instruments. These are these fair value measurements. Any question?
There is no question, Mr. Muiwa. I just want to appreciate the fact that, as a matter of fact, before when we started these financial instruments, like I told you earlier, I have zero knowledge. But at this point in time, I'm very grateful to you for your time and for the knowledge sharing. God will bless you. I'm no more in zero level, and I promise I will intensify efforts to delve into more practical questions in order to be able to stand on my ground on financial instruments. Thank you very much.
Okay, thank you. Thank you to others also, because there will be another section for other categories of students now. Thank you very much. God bless you. We'll meet tomorrow once again. And from there, we'll start to discuss on employee benefits, IAS 19. Thank you very much, and God bless you all.